All right. Well, today, everyone, thank you for coming. For those who are here live with us in Zoom, if you're on Facebook, REI Secrets, watching live, welcome. Or if you're watching the replay, thank you for tuning in. And today we're talking about business entities and how to cover your assets. Um, you know what I mean? And it was interesting, Keith brought this up as one of the potential topics, and I was like, it kind of sounds boring. And then if you have owned a business for any amount of time, you know how important it is, at least on the tax side of things, to reduce your tax liabilities so that the government doesn't walk away with all of your money. Because the government will take as much as it can, and your job and the job of your tax accountant is to make sure you keep as much as you can.
Yep.
So that's one of the topics today, and then also how to really protect yourself from lawsuit, like if someone gets hurt on your property. So Keith's going to explain all about that. Like if you have a rental property, it's a property you own, and if you owned it in your name, and God forbid something terrible happened, they could sue you personally. And in order to prevent these things from happening, there are certain, ways to set things up and more. Keith's got a ton of information here, stuff I had no idea about. And I'm sure a lot of it's more specific to real estate investing and owning property ownership. Yeah, I owned a business for a while in Japan, and that was different. I didn't own properties per se, but insurance was certainly a thing. And then, you know, as trying to keep as much as my money as I could, because the Japanese government will take more of your money than the U.S. government. They, they like
Yeah.
taking money from people.
Yeah.
So it was quite frustrating. I often said to my wife, "How the hell can we make any money in Japan? They take all your money." But yeah, Keith, go ahead. And the other thing is we don't sell anything related to this yet. So I'm gonna like Keith is gonna go nuts and just share everything. And if you're here, then you get to benefit from that. You get to know
We have nothing
whatever
to
Keith
sell
is
you.
willing to share.
This is free
Not
information.
yet. So it is right now. It's free right now. In the future, it won't be because I'm gonna
Yeah.
turn this into a product and it will not be free.
Yeah.
So now you get to be here. If you're a client of ours, you get access, of course. If you're not, eventually this will be something that we sell because it is inherently valuable. And but today only, it is absolutely free, and the replay will be free for a short period, and then the replay will disappear. So Keith, go nuts, share all your secrets,
All right.
and if
Sounds
you're
good.
here today, welcome Glenn and Bomi. Well done
Thanks for
for
being here.
joining. You obviously understood there's some value to be gained. So Keith, without further ado, go ahead, sir.
Ryan always does such a great job titling these things. He'll ask me, we have a running list of all these topics. And he asked me, hey, can you just shoot like shoot me a voice memo, 5-minute voice memo about what you want to talk about. And so I don't tell him how to title this. And what a creative way. I absolutely love it. How to protect your assets. This is what we're talking about today. Hey, before we get into what I would like to discuss, I have a disclaimer. And the disclaimer is take us back to young young and dumb Keith in 2016 when I was starting off investing in real estate. I paid a business consultant $7,500 to set up my entity. I had not done a deal, but my God, are my articles of incorporation so rock solid. I have multiple golden parachutes. I have I had not only did I have a tax attorney, but I had a litigation attorney. I had a business attorney, all consulting my business consultant on how to structure this for me. I had everybody in their involvement. And my disclaimer is I wish that I had done it differently. Because everything that I'm about to talk today talk about today is in the future of you doing deals. Meaning, if I had done all of that and spent $7,500 to get everything set up, to make sure that if I was ever sued, it would stop at the corporate veil and it would stop at the limitations of my entity. And I had protected myself with anonymity. You know, you can't really see anything that I own because I don't own anything and all of these things. If I had set myself up perfectly, but I had not done a deal, then it was all for naught. And I see so many people. I was telling somebody today, I believe that this is true. The number one cause of death in America is heart disease currently, I believe. And the number one cause of death for real estate investors is analysis paralysis, thinking that they have to have all of this stuff set up and put together and know every little detail from beginning to end before they take action. What a lie. What a lie that is based on fear of, like, you'll go to these events. Trust me, guys, I have been to so many events, and they'll get somebody up there that talks about litigation and asset protection. And they'll tell you all these horror stories, and then you just rush to the end of the room to get your entity set up. And it costs minimum $3,500 to do this stuff properly. And then they have different packages, $7,500, $10,000, $12,000, whatever. And then these folks like never do a deal, or they'll do like one deal and then they quit. So my disclaimer is that I wish I had done things differently, and it is absolutely acceptable for you to start doing deals in your personal name in the beginning. And you can get the cart in front of the horse and spend all this time and all this money making sure that everything is perfect. And if you never do a deal, then it's all for naught. And so I'd encourage you, if you're listening to me right now live or in a recording and you've never done a deal, then everything that I say after this is a nice to know, but not a need to have. It's a nice to know, hey, that's in the future. This is what my future looks like, but you don't need to do this. You need to get your ass on the phone, calling some motivated seller leads that have an issue that you can solve, buy their house at a deep discount, solve their problem, and make some money along the way. That's what you need to focus on, not getting your entity set up. That's my disclaimer. Thank you for coming to my TED Talk. Now, let's talk about entity structures. There's largely two different reasons to have an entity. The first one is going to be taxable liability. So if I, Keith Gillespie, as a person, make $150,000, then I'm going to be taxed. Let's say I fall into a 28% tax bracket. $150,000. Oh my goodness. Somebody do 150. Here we go. Never mind. Times 0.28. My computer is being very, very slow. $42,000 is going to be what I'm taxed. I'm going to pay Uncle Sam $42,000. This is robbery. I am not going to pay $42,000 if I don't have to. And so what having an entity does, so an entity, let's talk about what is an entity first. An entity is common, like the most common ones would be an LLC. There's different types of LLC. There's sole proprietors, then there's multi-member LLCs, and there's different designations of an LLC, because an LLC can be taxed as an LLC and it can also be taxed as an S corporation. You can have a corporation, and there's different types of corporations. You can have a C corporation. You can have an S corporation. Those are largely the ones that we're going to be talking. There's trusts as well. I'd like to talk about trusts in this call. So we're largely going to be talking about LLCs, corporations, and trusts in this call. Those are really the only ones that are going to be pertinent to you as a real estate investor. So let's say Keith Gillespie makes $150,000, and Keith Gillespie spends $120,000 to do life, right? To pay for my house and my car and my food and travel and our kids' school and yada, 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 yada. I spent $120,000. Well, that's dumb, because I have just spent actually more than I earned, because 120 plus $42,000, which is my taxable liability that I must pay the government, leaves me upside down. I only made 150. This is where entrepreneurs get this stuff wrong all the time. We live paycheck to paycheck. Well, this isn't just entrepreneurs. Americans get this wrong. We live paycheck to paycheck. And when you're on a W-2, that's fine. When you're on a W-2, that's fine. Why? Why is this fine? Because your employer is holding back money for your taxes. As a W-2 employee, you actually get a refund. They're withholding so much of the money. The employer is withholding so much money that they pay it to Uncle Sam, and Uncle Sam says, hey, we're sorry, we gypped you. We actually owe you $6,000. Don't let this happen. You have just given the United States government, God bless America, by the way, I'm all for it, but I'm not okay giving them a $6,000 loan for 12 months at 0% interest. That's effectively what you've just done. I don't like this. And we live paycheck to paycheck. And if you spend all of that money, so 150 minus 42,000, 150 minus $42,000. My calculator is like not working. That's 98, right? I'm not really good with math, especially on the spot. 108. $108,000. If you spend more than $108,000, what are you going to do when Uncle Sam comes knocking? This is why people fall into the trap of actually owing the IRS money. And then they have, the IRS will garnish your wages and a bunch of bad stuff will come about. Whereas if you have an entity, and that entity, same numbers here, that entity makes $150,000. And that entity spends $120,000 in order to exist. Here's the difference. Me as a person, I have a social security number. That entity, as its own individual entity, has an EIN number. The EIN number is the equivalent of a person's social security number. Here's what's great. As a business, your expenses lower your taxable liability. As a person, your expenses don't mean crap to the government. And so if my business makes $150,000 and I expense $120,000, I don't pay taxes on 150. I pay taxes on the 30. So how much am I going to pay in taxes? $6,000 or something like that. $42,000, $6,000. What would you rather pay? And so on the books, you can, and I do, write off your lifestyle. This office is rented. Behind this wall is my wife's office. That's rented. This is REI Automated's office. That is Mira's Motivator's office over there. You can expense your car and the miles that you drive. You can expense, oh, the tax bill got changed last year, I believe, for food. Oh my goodness, absolutely amazing. You can expense your food. You can expense your travel. You can expense anything that is used for business. This desk, when I bought this desk, business expense. These monitors, business expense. Microphone, camera, light, desktop, gym, Wi-Fi, cell phone plan, medical insurance. My life is expensed. Like my personal expenses are very, 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 very low. Why? Because everything is expensed through my business. And I have been audited by the IRS, by the way. It is not fun to get audited by the IRS. It took almost a year to get through it. And they went through our books with a fine-tooth comb because we made money and we expensed everything. And we were extremely aggressive. And guess what happened at the end of the audit? I did not owe any money. We played by the rules. I had my CPA and bookkeeper sign off on absolutely everything. So if, God forbid, something were to happen, it's actually his license on the line. And we did everything properly. And so it looks to the government like I make so little money that I cannot live in a van under a bridge. Now, there's a bad thing about this because it means I can't go get a personal loan. It's very difficult for Keith Gillespie to get a mortgage. It's very difficult for Keith Gillespie to get a car loan. Those are the bad things about what's going to happen. I'm not just going to make this sound super sexy. There are cons to doing what I'm saying. By the way, the perfect number, if I could choose, there's no perfect number, but if I could choose a perfect amount to be paid, it would be $150,000. If you make $150 per year, then you can pretty much you can buy a nice house, you can buy a nice car, you can get credit cards, you can do anything without a problem. The moment you get paid more than that, though, you're just giving way too much money up to the government. But this is taxable liability. So even if my business makes, so gosh, like $1.2 million ish, but what were our expenses? Like 1.18. Like I'm not, these are real numbers. 1.2 is what we made. 1.18 is what we expensed. So how much did I pay in taxes last year? I believe the exact number was $2,400. It's something like $2,400 is all I paid in taxes. That's, you may not believe me, and that's okay. And I don't really care what you think anyway. That's really good. It's really, really, really good. That's where you want to be.
Yeah, that's pretty crazy.
If you're being extremely aggressive.
Yeah, it almost feels yeah, as you said, aggressive. It almost feels a little dangerous. It's interesting to know that you went through that audit. Why did it take a year?
Because they went through every mother freaking document for the past 3 consecutive years that we filed our taxes.
Okay.
We go back. I don't know, most people know this, but you can go back and you can change. I think it's up to 5 years of tax returns.
Yeah, so something like that.
We go back every year and amend the last 5. And this
Oh.
year we'll amend the last 5. And the next year we'll amend the last 5. Because you have to show, so like to get a loan. By the way, I'm sort of waiting for the market to dip down. But I'm going to be moving a little bit further north. And when we do, I think that this is going to happen next year. And so I'm changing last year's tax return to be $150,000.
Oh, that you made.
Yeah.
Yeah, that makes sense.
So that I can go get a VA loan
I did the
super
same
low
thing.
interest rates. Yes.
I did the same thing. And they were, because I was like, oh, I want to build a house. I needed a loan. And they were like, how much do you make?
Yeah.
I was like, well,
don't ask that question.
Really depends on how we want to calculate this.
Wait until I change this paperwork, and then I'm
gonna go talk to my tax accountant. We're gonna make this look right on paper.
Yes.
And it was funny because then I was like, okay, well, how much do I need to make to get this loan? Oh, you need to make this amount. Right. Okay, great.
Yes.
Thank you very much. I'll be right back.
Yes.
Give me a week.
What we're doing, it's not unethical. You're going to change your tax returns, and then you're going to pay the taxes on that money as if you had claimed it then. You have to pay the taxes, right? Yeah. What we're doing, number 1, is not unethical, and number 2, it's not illegal. Matter of fact, here's the thing. Y'all realize this already, but I'm just going to say it. The rich get richer and the poor get poorer. I don't care where you land politically with the Great Divide and whatnot. The rich get richer. Why? Because they make more money, yes, but also because they keep more money. Wholesalers get wrecked in real estate because they make so much money and they can't expense anything. It's very hard, I should say, to expense this stuff. It's extremely hard. And
that's very interesting. So we want to hear more about that.
Yeah, I want to hear more about that because let's say that you make $300,000, $400,000, $500,000. What you're going to fall into a high tax bracket, and 40% of that crap goes away. Bye. Why
can't you expense what you're making as a wholesaler? What's the issue there?
What do you expense? You can expense people in your business, and you can expense data in your business.
I see.
And you can do other things, but there's no depreciating assets that so when we flip a house, for instance,
yeah, go ahead.
You can do what's called, is it called cost segregation? All right. So now we're getting into the point. I wasn't prepped.
You weren't ready. Sorry.
I wasn't ready to talk about like tax stuff. I was talking, I guess this is taxable liability, but I think it's called cost segregation, and it's like accelerated
depreciation or appreciation, something like that. Yeah.
Depreciation. So basically you have the right to depreciate this asset over 29 years. But for a kitchen, you can depreciate what you paid for the kitchen. You put 20 G's into this kitchen in this house. You can now depreciate that over 3 years. So that
Right.
lowers your taxable liability for those 3 years. It's accelerated. You don't have to do it over 29 years. And you can do a roof, for example, for 10 years or 15 years or something like that, right? So there's items that the IRS says. And here's the thing, going back to the rich get richer. Why do the rich get richer? Because they play by the rules. Who makes the rules? Rich people make the rules. Business owners pay people to lobby to put
Favorable
laws into
laws in
place.
place.
Yeah,
Yep,
for
of
them
course.
to freaking keep their money. So here's the thing,
Yeah.
if you want to get rich, learn to think, number one, learn to think like a rich person so you make a lot of money. But number two, learn to play by the rules. Learn what the rules are. And listen, guys, I don't know the rules. I'm not a freaking, obviously, I'm not a tax expert. But my CPA, gosh darn it, this man is one of the brightest minds I've ever met in my life. Literally, this man can quote tax code. He knows where it is. He knows exactly the subsection of whatever freaking chapter to get to what he needs. It's amazing. We pay our kids out of each one of our businesses. We pay our kids. I think you can pay your kid like $12,000 or something like that each. So we pay our children. Why do we pay our children? Because they're freaking expensive, dude. You know how much they eat?
You
So we,
can't do that in Japan, by the way.
oh, the lame. That's
It's,
super lame.
yeah, it's super lame.
So you need to have a reason. You'll see that sometimes in my videos, I'll have my kids in the video. Why? Because I have to justify why did I just pay that kid $12,800 or whatever the gig was for. Like we actually have an agreement. We actually have a family planning, I don't know what it's called, a family planning company that we pay and that rolls into our kids. And then now we can pay for their school uniforms and stuff like this. So learn the tax code or find somebody who can teach you this, like a CPA, qualified, really good specifically in the real estate investing sector, to teach you these things. Because when you know the rules and you play by the rules are meant to get the rich richer and to keep more of your money. The problem is so many people, it's just like, it's the status quo to pay your taxes. I'm all for, I understand that taxes are like necessary to keep law and order and roads. And well, God knows, your hard-earned
A standing
tax-paying
military.
dollars, yeah,
We appreciate that.
paid for
Yes,
me for 8 years.
that's right.
So I understand that it's necessary. However, I selfishly want to keep more of that money in my pocket. So taxable liability, if you have a business like an LLC or a corporation, then your business will make money. You expense most of that out. What is your net proceeds? You're going to pay taxes in whatever tax bracket that falls into.
So are those when you take control of a property, that's an asset. Is that a is that a tax write-off essentially? You bought a house, so that's an expense on the business. Is that how you're
Yeah.
because that's the
So
difference between the wholesaler versus the investor who's acquiring properties. Is that what you're
right,
saying?
right. But then even more than that, like when I buy that house, yes, I bought that house
Oh,
and yes, money left, but then like there's a lot of additional things
the
because
repairs or something.
I borrowed money to buy that. And
Okay.
here's the thing, when you debt, you don't pay taxes on. This is a really cool thing. Debt, you don't pay taxes on. So if you ever have, a bunch of equity in a house and you pull money out, you can do whatever you want with that money. It's just like you made that money, but it's not.
Oh,
It's debt.
oh my goodness. So like when you do that hypothecation,
Yes.
oh, damn.
You do.
That is amazing.
You don't pay
Oh,
taxes on debt
so
ever.
all right. Do you guys know what hypothecation is? It's where you borrow on the note. Is that right,
Yes.
Keith?
Yeah, that's correct.
Keith
It's when you
explained.
borrow on your
Keith
note.
knows more than I do.
You can,
So
whenever
it's
you own or
yeah.
finance a house, you can either sell in, let's say that I'm owner financing, I'm gonna, it's $100,000 note and I'm gonna cash flow $600. And like, I don't want $600 a month. I need $80,000. I can either sell that note or I can borrow against that note. Borrowing against it is called hypothecation. If I sell that note, that was a sale. Sales are taxable events. 100%
Right.
of all sales that I know of are taxable events. And so you would pay
Yeah.
if you made gain, that gain is a taxable event. You have to pay taxes on that gain, i.e. capital gains. Think about this. Capital is
Yes.
money. Gain, if you ever made money on a gain by a sale because it's a taxable event, you pay Uncle Sam. Whereas if you hypothecate, and I didn't even get into this into the training, so I'm kind of impressed that you brought it up just now. Not only can you double dip, meaning you hypothecate the first half of the note,
Yeah. Yeah.
you get your $80,000, you pay them back over the first 15 years, and then you hypothecate the note a second time. You can double dip, you can even
Yeah,
triple
that's
dip
right.
into this freaking thing. But the money that you got is borrowed money, it is debt. So you don't pay taxes on it.
That's amazing.
Hello. Yeah, that's another reason why hypothecation is great.
Because like, when I and I don't know what you guys all do if you're some of you are doing a lot of wholesaling and stuff, but and I when I was first learning about real estate investing, I was like, ah yeah, it seems like wholesaling is probably the one of the best ways to do it. But then when you brought up this concept of when you've got the note, you can borrow against it, and actually there are
Mm-hmm.
people who will pay up to like what was the percentage? 80% of the value or something like
Yeah,
that.
it depends, but
So it
100,
depends.
even you can go over 100% in some cases.
Oh
But
my
yeah,
goodness. So, but
75, 80%.
anyway, like if you can do that, that's potentially way bigger than a wholesale
Yes,
that you're getting. And if it's not taxed,
not
at
taxed at
least
all.
that amount isn't taxed, but something is taxed, right?
Well,
The
eventually,
monthly payment on the note eventually,
but
like you,
even that, dude, it's all written into the tax code for you to kick the can down the road,
right, down the
literally
road.
until you die. You're like, I
30
don't want.
years.
Yeah, that's what a 1031
Okay.
exchange is. Is I'm selling
Oh
this
my goodness.
house and I'm gonna roll this house capital gain. So if you're unmarried, it's $250,000. I can make $250,000 as an unmarried man as long as let's see if I remember this. In the last 5 years, I had to spend a minimum of 2 years in the house. Pretty sure that's what you have to do in order to qualify for this. Then you sell the house. If as long as you made less than $250,000 is 100% tax free. If you're married, then you both get 250, so it's 500,000. Half a mil is what you can make as long as you're rolling it into like real estate. So similar real estate. You cannot go from freaking mobile home into a commercial property or something like that. So it needs to
Okay.
be like real estate, similar real estate, and it needs to be an upgrade. You cannot go from a apartment down to a single family house. It always has to be an upgrade, which makes sense anyway because you're making money. You're making money,
Yeah,
so you're gonna get an upgrade.
right.
Um, and literally, you keep on doing this every single time. You will never pay taxes until you die. And now we get into estate planning and structuring your entity and having a trust and creating a nonprofit and gifting things away. And this is why you see people do crazy stuff when they're 70 and 80 years old who are very wealthy. And you're like, wow, this person is gifting this much and they have this
Yeah, they're
nonprofit
such a
charity.
philanthropist. They're so
Yeah,
generous.
okay.
Are they?
That's been in the works for like 30 years, bro.
Yeah.
They just don't want to pay the taxes and they don't want more than anything. They don't want their kids to have to pay taxes on
Right.
all of that stuff. And so
Yeah.
if you have your estate planning correct, and I'm not, I'm still a ways from thinking I'm gonna die. So admittedly, like we have a life insurance policy and we have trusts and everything like that. But when it comes to this, I'm not really thinking about it. It's a ways down the road. But you can kick the can down the road, and when you pass, you can structure so that your kids don't have to pay the taxes on all of that gain that you have
Mm,
pushed your entire life. Okay, let's get back.
crazy
Taxable
stuff. Yep.
liability.
Go ahead.
That's reason I told you there's two reasons to have an entity. Number one is taxable liability. You make $300,000 and you expense 250 of that. Congratulations, you're only going to pay taxes on the $50,000. What is that going to be? 11,000. I don't really know what it's going to be. Next.
We're not going to make Keith do math. It's
Yeah.
not a strong point.
I don't actually
Okay.
know what the tax bracket is for
Just
$50,000
figure it out yourself.
Next is going to be this. The second reason why you would want to have an entity is the entity is separate from yourself. As I explained earlier, a person has a social security number, and a business has an EIN, it is taxed and it is treated like its own person. I am an entity. Ryan is his own entity. Crown Properties is its own entity. REI Automated is its own entity. Every business is its own entity. And because of that, there's a corporate veil that protects me. I am separate and apart from my business. Yes, I control my business and I'm the owner of that business, but you cannot pierce the corporate veil. In extreme circumstances, if I go murder somebody, yes, the corporate veil, time and time again, if you look at case law, that's when the corporate veil is pierced. But other than in extreme circumstances, that corporate veil will hold true. Why does this even matter? Let's say that you have a rental in, where's a bad place? Downtown Chicago.
I was
And
thinking the exact same thing. Wow.
I brought that up because a very dear friend of mine, he had a family member just get shot 2 days ago.
Oh my God.
And like, God forbid, so you have somebody who's renting a house from you and they're in like the ghetto and they get shot or they trip and fall and they break their back or they die or I don't know. I have no idea what's going to happen. This is a litigation heavy industry. You get sued for absolutely anything and everything. Something horrible happens in the house that you're renting out to this person and their family comes after you in a lawsuit. Well, if you personally own that house, they can come after all of your personal assets. If you own your home, it's now their home. If you own a car, it's now their car. If you own everything that you own, they can come after you for. Whereas if you have this thing in an LLC, corporation, there's a corporate veil. They cannot touch your personal assets. They can touch anything that's within that company. And so then we get into like really advanced entity structuring where if you have enough deal flow, again, I'm going to go back to that disclaimer. Even if you're doing deals right now, this doesn't apply to you unless you're doing like 100 deals a year. The front facing company, the property, I mean, the company that the seller is interacting with should never own anything. That is your front facing company. It's on the front end of the house where everybody sees. I want you to think about a restaurant. You come into the foyer and you have, the lady who's standing there and you have to get in line and tell her how many people you have on your table. That is the front facing company. Where you're seated is you're now in the house. That's the middle company. And then the kitchen, the thing that you never get to see, that's your holding company. So if you have a front-facing company, that's the one that any seller that's mad at you is going to sue. If you have flips, active flips going on, you should have them separate from this company if you have enough flips. Because anything that happens in this company is subject to a lawsuit. If this company gets sued and it owns real estate at that time, it is subject to that lawsuit. So if you have flips, then that's like your middle company. That's the house where people are seated, they're eating their food. And then if you hold notes or long-term rentals, there should be a holding company. And this holding company, each one of these is a different entity, by the way. You're just quit claim deeds or assignments or whatever to make sure that everything is clean on the books. And each one of these is separate companies and they need to be run as separate companies. So technically there's a profit when it's sold from this house is sold from this company to this company, there's a profit. This is when we get into like series LLCs and stuff like that. Let me try to stay on topic here. Corporate veil. That's the purpose. The second purpose. So purpose number one, taxable liability, making it so that you're paying less money to Uncle Sam. Topic number two, or reason number two,
Right.
is
So for like for someone who's maybe not doing 100 deals a year, maybe they're just doing,
one entity.
10, 20, one entity. But specifically, which entity do you recommend?
Oh, yeah, great
Which?
question.
Yeah,
This is a
I
huge
yeah
topic. There's tons of videos on YouTube, probably from people who are a lot smarter than me.
yeah.
But
That's okay.
this is kind of an easy to understand way of doing it. So I told you that there's going to be two entities that we're talking about a lot today, and that's an LLC and an a corporation, an LLC and a corporation. If you're going to be making less than $50,000 per year, you should have an LLC. Why? Because you're going to be a W-2 employee of that LLC, and it's going to be a pass-through entity. It's just going through, and you're paying taxes on this money that's less than $50,000. The moment you go above $50,000, you now should have a corporation. Specifically, what I would recommend is an S corporation. There's not many instances where anybody's going to benefit from a C corporation. We have one client actually who has a C corporation, and I absolutely back his approval for that C corporation because of his structure. He is allowed to do this one thing that is very different than everybody else, which is you can be a publicly traded company. You can sell shares and stuff. Most people, nobody cares about that. That's what a C corporation is for. S corporation, that's what I have, by the way. S corporation, the reason why you would benefit from having an S corporation above $50,000 is because then you don't get double taxed. So self-employment tax is 15.3%. And if you have an S corporation, you no longer get double taxed. With a pass-through entity, you avoid paying that. The only thing that you're going to pay is 15. I'm fairly confident it's 15.3. Let me ask Google. How much is self-employment tax? All right, it's 15.3%. That's the only taxes that you're going to have to pay. Is the 15.3%. With that said, above 50,000, S corp. Below 50,000, LLC. Now, there's one caveat to that, because I just said above $50,000 S corporation, but I didn't actually mean S corp entity. I mean S corp designation. Because you can have an LLC that has an S corp designation. This is beneficial because S corps, there's a lot of paperwork that you have to do for an S corp. Also, all your registration fees are way more expensive as an S corp as compared to an LLC. In some states, an LLC, dude, it's like $99, $129. For me to register my S corporation, it's the same freaking thing, but I have to pay $699 every year in multiple states. I don't like this. And again, if I could go back and change what I did, I would. I would have an LLC that's taxed as an S corp. So all this is a document, tax document, and there's literally a checkbox that says I would like to be taxed as an S corp designator. That's the S corp designator box. Just check it. Now you're taxed as an S corp. Now you don't have to pay double on your taxes. You only pay 15.3% for your self-employment tax because you have that S corp designation. So,
Well, that was worth the price of admission right there.
thanks.
You guys didn't know that, then that was, I think that's like really for anyone who's just getting started out, running a business, any kind of business. That is very helpful to know. It's different from what I've experienced, but yeah, it's really interesting. So cool. So that's you know setting up the LLC in the beginning, and then like how like let's say you're in the middle of the year and you're like, oh dang, I'm gonna making more than 50,000, for whatever reason. Can you switch mid-year? Like how do you know any about like did you ever do that? Have you ever
So
like
you don't
gone
have to
back and forth?
switch. Each year you're going to select, am I with an LLC,
Okay.
you're gonna select, I want to be taxed as an S corp or I want to be taxed as a regular LLC. And it really did, and I mean you're doing this well
Okay.
knowing like you're gonna file your taxes in April, right? Or
Okay, yeah, right.
here's another little hint. Statistically, I love probability in statistics. Statistically, You have a higher likelihood of being audited if you submit your taxes in the month of March or April than if you get an extension and wait until July or August.
My dad always
So
did that.
yeah, ever since I
He
got
never got
audited,
audited.
well, I always would file my taxes on time, and then I freaking got audited. I was like, never again. I'm gonna play the probability card here,
Yep.
and we filed our taxes late. We get an extension every year.
Yep.
So oh yeah, every single year you're doing your taxes in July for the year previous. So you've had 7 months to like clean up your books. You know exactly with your CPA, he will be able to run the numbers and say exactly this is how much you're gonna have to pay in taxes. So we should do this, or we should do this. Less expenses. There's so many things that you can do. My goodness sakes, there's so many things that you can do in order to lower your taxable liability and just make this as strategic as possible. And you can backdate everything, like I said, and you can go back and backdate the
Oh,
backdated stuff
right.
for 5
Yeah.
years.
5 years. So you could go back and be like, hey, you know what? Actually, I want to designate myself as an S corp for the last 5 years.
You know what? Actually, my company decided 3 years ago that they're going to start enforcing 401ks, and we're going to have a 1-to-1 match for the first whatever freaking amount. Hello.
Nice.
Like, that's a freaking good idea. I encourage everybody on this call who's ever listened to the sound of my voice needs to have specifically a solo K that's self-directed.
Right. That one. I want to
Roth.
hear more about that, but maybe not
Okay.
on this call. But
Yeah,
if
not
we
on this
could,
call. We'll talk
okay.
about,
That's really interesting. That
self-dealing and arm's length
self-directed, right?
transactions and everything like
Yeah,
this.
yeah,
Yeah.
yeah.
Solo K is the cream of the crop when it comes to it. Like
Very
401ks
cool.
are garbage. If you have a 401k, I mean, I didn't mean to say 401k, IRA. An IRA is garbage. Anybody who has an IRA needs to convert that crap. All right. But you can go back and you can change these things and say, our company, our corporation now is giving all of its employees, hey, guess who's an employee? The owner. We're going to give all of our employees 401ks. We're going to put this much amount into your 401k expense. And then if you choose to be putting more in, we'll match it. Expense again. And then you can take that money, borrow it as your EMD, your $1 EMD per your house. You borrow $1, you make $40,000 on the deal. You put $40,000 in tax free. When you know how this stuff works, you can make an ungodly amount of money and it's not taxed. You will keep so much more of your money. Okay, we've talked about taxable liability. We've talked about corporate veil. We've talked about LLCs versus
You want
S
to talk about
corps.
trusts, right?
Yep. I want to make sure that I've hit all the wickets. We've talked about LLCs versus S corps. We talked about the designation. Okay, I think I'm ready to get into trust. So trusts. What is the reason to have a trust? Simply put, anonymity, meaning being anonymous, remaining unnamed, having control over something, but not owning anything. So there's 3 people. Let's see if I can remember this. I can go grab a trust if need be. There's 3 people in a trust. You have the grantor, who's the person who is making the trust. Then you have the trustee controls the trust. And you have the beneficiary, who's the beneficiary of the trust. Now, I'm likely going to forget one of these 3 names. I always do. Trusts are so hard for me to remember these names. Grantor, trustee, beneficiary. I might need you all to pipe up and help me when I forget one of these. So the grantor is the person who's creating the trust. The trustee is the one who controls the trust, and the beneficiary is the one who benefits from the trust. The only one of those that's actually relevant, though, is the trustee. That's the only person who's ever recorded. Does it mean that they own the trust? No. And does it mean that they're going to benefit from the trust? No. It simply means they control the trust. So I am not my own trustee. I have another person who's my trustee, and that trustee knows to shut their mouth if anything ever happens and never give up who is the grantor and who is the beneficiary of my trust. They will never speak unless we're in a deposition and he has to. Other than that, the reason for a trust, the reason for a trust is anonymity. So if you have a house that you want to hold, I recommend putting it in a trust and having the beneficiary of that trust be an LLC. Why? Because then you're protected from both the inside and the outside. And you can write off your taxable liability. You're protected from the outside, meaning nobody knows who owns this trust. It's very difficult to pierce that, if you will. You have to litigate, you have to go through depositions, you have to sue, you have to win, you have to be awarded the judgment, and then you have to collect on the judgment. So there's like literally a 6-step process that's going to take years and a lot of money. So putting a property in a trust is going to keep you safe, you personally safe from that. No, I shouldn't say safe, because that means like protection. A trust doesn't provide any protection other than nobody knows that you own it. So if they don't know that you own it, are they going to come after you? If you are being sued or your company is being sued, can they find you in public record owning all of these properties? No, because it's not in your business name and it's not in your personal name. It's in 123 Main Street Trust name, or Freedom Fighters of America, or you can come up with any trust name that you want. So you could be like, what's a very benevolent sounding name? Homeless Children of America. Is anybody going to sue the Homeless Children of America Trust? What a dick move. If you put that property in the Homeless Children of America, feeding families, that's even better. Feeding, I don't freaking know. Just think about just a very benevolent name. Like literally, I do this. I put houses in trusts that are named these things because nobody is going to come after that. And if they do, there's going to be a lot of negative publicity for that company. And there is. You can actually find this stuff. So you put your property in a trust. And if, God forbid, anything ever were to happen, who is the beneficiary of that trust? The LLC. Therefore, they cannot come after you personally. You're not going to lose your personal home, your car. They're not going to garnish your wages. They're not going to come after your wife and your kids and your firstborn son and everything like that. It's all locked in. You are both protected from the inside and the out. The out is somebody tripping on your porch and suing you. The inside is lowering your taxable liability because you're going to make money in this property. That money needs to be expensed. Otherwise, you're going to pay taxes on all of it. That money needs to be expensed. And you can do that through that structure. Trusts are very easy to create, by the way. At this point, I have a template. I have a template for personal property trusts. I have a template for land trusts. And the reason why I have two is because a land trust cannot have a bank account. This makes it hard. The only thing that a land trust can do is own land. That is it. And so I don't want to go into like how I have all my stuff structured, but it's beneficial sometimes to create multiple layers of things, multiple LLCs and multiple trusts. And so you'll have an asset, a house, in a land trust, but who owns this land trust? A personal property trust. And who could own that personal property trust? A 401k. If you didn't know a 401k, that's actually a trust. That's a trust fund. A 401k could own this, and therefore all of the money that's being made goes into your 401k tax-free. Did you know that you don't have to own your 401k? Now we get into some really advanced stuff. You can have an LLC that owns your trusts, and that LLC can be owned by a corporation. So all of these things can be filtered through so that you get the benefits of everything. You get the benefit of an S corporation, so that you're not dual, what is it called? Like dual taxation. Like you're not getting double taxed. but then it flows through your LLC. If you wanted to pay other employees, like your kids, for example, your kids can't make more than $50,000. It's limited to, I think it's next year, it's going to be like 14,400 or something like that. And so I have two kids, 14,400 is $28,000. That's less than $50,000. Beautiful. I should have an LLC then and pay taxes on that, because that's less than the 15.3%. What else? Oh, and then having the trust for anonymity.
Very interesting. And I think, yeah, obviously there's probably like a lot of questions on how to do this, and that's obviously something we can't get
Oh,
into.
well, I was gonna touch on that topic a little bit, actually.
Okay. All
I
right. All
said
right.
I have a template. So our attorney drafted up all of this stuff for the very first time that we were putting a property in a trust. And I
Hmm.
said, hey, thanks so much for doing this. I changed my mind. I don't want you to create a trust for this property. I instead want you to go back to the drawing board and give me both a personal property trust as well as a land trust that is templated. And it's
Okay.
actually really easy. So now I have these two documents. You should always have, your trust set up by an attorney specifically for you, and what are your needs? What are your family's needs? What are your hopes, plans, dreams, aspirations, whatever? What is going to happen in the future? A lot of that stuff is tailored into your trust. The other structures that you have is tailored into your trust. And so he did that for us, and everything is templated out for me. So every time that we have a property that we're going to hold, that is always just put into one of those trusts. Like I said, it's a template at this point. So
Cool.
we'll put it into a land trust, and we'll have the owner of that land trust be a personal property trust. And sometimes it's owned by an LLC. Sometimes it's owned by a 401k. There's a lot of different reasons of why you would want to structure it differently. It's all legal tax evasion, though.
Yeah. Yeah. Legal tax evasion. Great. We love it. All right. Well, as I said, Keith can talk for an hour without any help.
Oh my goodness, how much
Uh,
time have I talked?
but we will take a few questions. I've been trying to ask some questions that I imagine some of you might have and keep the conversation going. But I'm sure there are a few questions that you guys all have. So if you have something you want to ask, now's the time. So go ahead, just unmute your mic and shoot.
So Keith, I was curious because like you said about like holding properties in like a given entity, and now you've just kind of divulged that you do it more in trust because like at one point you said from a liability perspective, not tax liability, but the actual like being sued liability, that if somebody was to sue you, they can only go after what's in the corporation. So I was going to ask you how many how many properties slash notes do you hold in one entity? But seeing as you do it in trusts, I'm assuming you do a new trust for each one, and then does it
Exactly.
matter at that point? Because
Yes, it does matter. It
okay,
does matter, because are they going to sue the trust? Eventually, if they have enough money, they can take it to, well, who's the beneficiary? The beneficiary is the LLC.
right.
And that's when you get into like, there's a lot. I'll give my opinion. And honestly, like, I practice what I preach. This is not applicable until you have hundreds of properties.
Right.
And like, I'm not there yet, so I'm not really worried about it. My magic number is 10. You should have 10 or less properties, each in their own trust under an LLC. But who cares what Keith thinks? Go talk to somebody who has thousands of properties and see what they
Sure.
think. I've heard literally polarizing opposites from people who have thousands, like my mentors are those people that have thousands of properties. And one of them will be, we create an LLC for every one of them. And I'm like, God dang, that's $100 every single year for every property. My God, how do you do that? That is so expensive. That's a lot. Think about that actual number. You have
Just the time too to maintain them.
yes. I have a friend who owns 2,400 doors that I know of. Haven't talked to her in a while. 2,400 times $100. That's $240,000 per year just to keep these LLCs. I would be scared that I missed a payment and now my LLC they're going to come after me. And then literally on the other end, people that I'm very, very close with are like, dude, that is a bunch of baloney. It is all marketing in order for people to make money creating the LLCs and for the state to get paid on all the LLCs that you've just created. And so he doesn't believe that you can have an unlimited amount. You just have one LLC and you're fine. I don't
But
really know.
also don't you have to keep corporate books, so you don't pierce the veil. So if you've got
Yes.
240, I mean, that's a full-time job making notes.
Yes. Well,
And
my
annual
God, when you
meetings
have 2,400 houses, Lord knows you have enough to pay for a full-time bookkeeper and maybe a couple. But yeah, I don't really know the right answer to that. And honestly, I think that it's going to be different.
I was like
Right.
more looking just for your opinion, not like there is no right answer. Probably it just depends, like you said, on who you talk to and what their opinion is, and then what you're trying to do as far as your business and your life and how you want to structure it and what you feel comfortable with, you know.
Right. That's exactly right. Cool. Great question.
Yeah. Good question. Yeah, definitely. Cool. Anybody else have something they want to ask about Stump Keith?
Stump the chump.
Yep. Let's play Stump the Chump. You can stump me easily. I don't know enough about this stuff. Certainly not in US. I think there's so much really to learn here. What are some resources that you recommend? And if you were going to, like, let's say Glenn here, I don't know you, Glenn, but let's say Glenn doesn't have a tax accountant yet.
Yeah.
What would be a good way for him to find someone who was like, how could he know that they were competent and could handle the complexities
Say no
of
more. I love my tax accountant. I don't get paid at all for referring people to him, by the way. I have easily referred him 50 people, 50 real estate investors. He and his wife are real estate professionals. They flip houses. But he's been a CPA. I don't actually know. Like multiple decades. He is. And if you think that I talk fast, this man talks like he's on 2.5x speed the entire time. I cannot believe how fast he talks. If you send me a message on Facebook or however you want to get in touch with me, I'm happy to put you in contact directly with him and his company. He owns a pretty large firm. He actually just acquired a new firm, and he is really good at what he does. I'm not promising that he's personally going to do your taxes, but I will promise that he overlooks everybody who does your taxes. And he is amazing. Another thing that I will recommend, let's see if I can find it. I purchased a very expensive course from Mark Kohler. If you don't know who Mark Kohler is, you need to get on this man's radar. You should find his business. Mark Kohler Associates, I think is his name. He has a lot of different companies though, of course. A little bit about Mark Kohler is he actually was if I remember correctly, he was an IRS litigator. He was the one that the IRS would go to and say, hey, this small business is gypping us. They aren't paying all their taxes. I want you to go sue them and get our money. And he did that for, I think, 12 years or 13 years or something like that. I sort of forget his story. It's been a while since I've been to one of his lectures. I went in person, though. Met the man in person. He came to Hawaii while I was there. And I had signed up before then, but I thought it was really cool to meet him in person. He did that for a little over a decade, I believe. And then he said, like this pays really well, but this feels wrong to me. Like these people are honest men and women. They are hardworking Americans. And they're not trying to wrong the government. They're just trying to live. They're trying to live the American dream. They started a business. They're doing the best they can. They're just not educated. And he said, I want to make it my mission to teach these real estate professionals how to do this stuff properly so that you don't end up in hot water. And so he has a business partner, he has a podcast, a YouTube channel. He has several courses, literally from $100 or maybe a couple $100 to thousands and tens of thousands of dollars, depending on how they'll do your entity structuring. They do some very advanced stuff. Like I'm not even on their level. The stuff that they do is absolutely phenomenal. They work with some of the biggest real estate investors ever in the nation. It's very, very good what they do. So Mark Kohler, that's MarkKohler. Just Google him, he'll pop up. That's a person that I have learned a lot. Like I said, I went through a couple of his courses. I've learned a lot from that man about both entity structuring as well as lowering tax liability the proper way. He has an amazing course. It's a great person. So is his business partner too. His business partner is really cool. I can't remember his name. So you need a CPA. We solved that. You need to learn about this stuff conceptually, whether you have a CPA or you don't have a CPA. Mark Kohler is the best resource for that. I'll tell you what not to do. Don't go spend $7,500 getting your entity set up if you aren't doing 100 deals a year. Even if you're doing 10 deals a year, like shut up. You'll get there. Again, you can go back and you can amend your taxes. You can create an LLC. 2 years ago. How far back can you backdate an LLC? I'm asking Google. No, this is not what I want. Not an LLC filing. I'm fairly confident that it's also 5 years, meaning like, and maybe it's 3 and maybe it's 2. I'm not really know. I know that it's more than 1 though. You can have started your business last year and you have done business and you have flipped houses and it's not made, but you can go back and file your taxes as if it was. This is super, super important. This is why it's like, don't get the cart in front of the horse. I really wish I hadn't. I spent so much money and so much wasted time doing it all the right way. And then I didn't get sued for 8 years. Y'all are going to get sued. If you stay in this business for longer than 10 years, you're going to get sued. It's not a matter of if. You can be completely above. I've won all the lawsuits, by the way. You can be completely above a reproach, but you will get sued. It's a litigation heavy, but it's just not going to happen until you're churning deals, and then it will.
Fascinating stuff. Does anyone
That's
have
all I
a
got.
last question? That's all Keith has. And that was a lot. So thank you very much, Keith.
Yeah, man.
If we have any more questions, if we have one more, we could field one more question. Otherwise, we are going to wrap it up today. And I think, yeah, it was really good. I enjoyed that. I learned a lot. So hopefully you guys did as well. Anyone have one more thing they wanted to ask about regarding covering your assets as a real estate investor?
3, 2,
No.
1. Okay.
Three,
Very
two,
good.
one. We're good to go. Well, thank you so much for coming today. Again, this month we've got Father's Day coming up this Sunday. So in celebration of Father's Day, we're offering 50% off our funding formula course to teach real estate investors how to raise private capital so that they don't put money into their own money into deals. You can borrow money. There's tons of money out there to fund deals. There's more money than there are deals, probably.
Absolutely. Without a shadow
Absolutely.
of a doubt.
There's more than enough money to fund every deal. You just have to start now, start creating that list of people who have money that they're ready to lend. And we teach you how to do that, how to set
Teach
everything
you how to
up, all the
find them, teach you how to vet them, teach you how to educate them, teach you how to get everything that you need, the documents necessary. It's all there.
It's good. So 50% off. I put the code in the Facebook group. It's easy to remember though. DAD50. DAD 50. Makes sense, right? So if you're looking for something like that to help you out, check it out. We'll include a link, and we'll get the replay out pretty soon into REI Secrets. So you can come and watch this for a limited time, and then and then it will go away into Ryan's vault. All
Cool.
right. Thank you very much, everyone, for attending. If you're watching the replay, thank you for watching. I hope you enjoyed this and that you learned a lot. Watch it again, take lots of notes, and set yourself up for success so that you cover your assets, so you lower your tax liabilities, you prevent yourself from being exposed to unnecessary lawsuits and litigation. And yeah, and really setting yourself up for success long term in terms of investing and all these things. So there's a lot more to talk about there, but we kind of scratched the surface to give you an idea of what's possible with the solo Ks and some of these kinds of things, how to get money into places where it's being held for you, for your children and their children, and it's not being taxed, and you're creating that generational wealth, which is, I mean, that's what being an investor is all about, right?
Agreed.
If you want to be a real estate investor, you need to be doing that, not just wholesaling, but doing some more of this kind of stuff. So I hope you get started on that journey as well, even as you're just doing your deals and thinking about how to do more of that. All right. We'll see you next week.
Cool.
We do this every Thursday at 6 p.m. Eastern Standard Time. So come join us. Okay. Thank you very much,
See you
everyone.
soon.
See you.
Have a wonderful day, guys. Take care.
Bye.